you very much. Thank you. Good morning. Hello. We're so glad to have you join us. So I think this conference always brings really wonderful content and gives us ideas to take back into our businesses, into our communities, into our governments. And it provides really good signal for what's happening in the world. And my career has been largely based in Silicon Valley. So M&A, the capital flow around how companies are created, the value that they're creating, who is interested in buying them, what creates a seller environment. This is really just a proxy for strength of the technological ecosystem, the capital that is powering investing in these companies. It's true in Silicon Valley, it's true in the rest of the world. So M&A is really a proxy to talk about everything that's happening. We just heard in the plenary session, there's chaos. We're trying to find signal in the noise geopolitically of what's happening. And so M&A is also a lens with which to look at how strong is the economic environment behind the technology that we're building, and what can we do about it today? So with that context, Larry and I have been friends for a very long time, business partners for a very long time. It's been really exciting to see Larry and his team at Goodwin become the most prominent tech M&A lawyers, deal makers in the world. We've got Stephen, who represents, long history of really bringing together Japanese businesses, most recently at Dai-ichi, really looking at how can you build inside the strength of Dai-ichi with other companies around the world, bolting into that strength, being able to look at opportunity for growth that way. And then Dan is a world-class former CEO of DocuSign, which is an incredible Silicon Valley-based company, but also now a storied board member. So really looking at this from the boardroom. And that's the context with which we're participating today. So I want to start with Larry. Larry, I feel like those of us in Silicon Valley who weathered the economic climate of 22 and 23 as we exited 24, even with this administration and its promise of being pro-deregulation, we were really poised for a breakout year for capital flow and technological growth through M&A in 25. What's the same and what's different in the last 3 months?
Well, first of all, thank you for having me here, Catherine. Thank you for Hori-san for putting this together. Incredible energy in that first panel. So I'm going to try and keep that up. We're the #1 M&A law firm in the world. We have been for 5 straight years. So just to give you perspective, we do over 1,000 deals per year on the M&A side. That only represents 0.5% of global M&A deal flow. So regardless of our standing in the league tables, there's a lot of deals that happen. The muted markets in 22 and 23, and for the large part 24, what happened in parallel with those muted markets was a massive accumulation of cash, both in corporate coffers and in funds. And coming into this year, as Catherine said, we were very excited with respect to those animal spirits coming out of hibernation. We know that from a PE perspective, a venture perspective, a growth perspective, and a corporate perspective, people want to deploy that cash. They want to create change in their companies, and the velocity of money is always the most important. It's not whether there is capital available, is that capital moving? And that has a lot of indirect secondary and tertiary effects on the innovation economy, global growth, et cetera, et cetera. When you think about the ability of funds to raise more capital, LPs have really put a premium on DPI versus TVPI these days. The initial changes in the administration around new leaders in the FTC and the DOJ, a new leader at the SEC, were incredibly promising. I still think they're very, very promising. I think what has changed now is the rapid pace, as we heard in the plenary session, of what's been happening in the administration, driving change, breaking the sort of rules-based order around the world, eroding trust. And frankly, M&A is a confidence game, right? If there is a lack of confidence in the boardroom, things will become very staid. And that's what we see in the markets. In the first 3 weeks of January, we signed 22 deals over $20 billion, and things have rapidly slowed to a halt. Now, when you look at AI as a separate market, we don't think anything has changed in AI. And this is indicative of the fact that unlike mobile, internet, cloud, this is less of a platform shift. This is more of a paradigm shift in my mind. And so everybody is thinking about how to continue changing their organizational behavior within their companies, changing how they view markets, customers, and their product through AI. Things are continuing to move at pace. And I think you'll see that in AI, people are going to evolve through M&A because it's just not an option to grow organically in AI. The pace of change is so fast that you have to keep up with it through M&A. So, who knows? I think, the next 3 to 6 months will be telling in whether the environment becomes a little bit more readable, a little bit more reliable. I think if we do, the rubber band will snap back pretty quickly in terms of M&A activity.
Thank you, Larry. I want to reserve the AI corridor for strengths, because I do think that today we're going to need some positivity to come from these discussions. So AI is a bright spot there. I am going to go to Dan quickly, just to round out. Larry brought up boardroom dynamics. What are you seeing as a board member as we head into 25 in the tech companies that you partner with and that you operate? Also, thank you for being on at 3:30 in the morning. I want to acknowledge that. But what are your insights as a board member in this environment?
Yeah, thank you very much for having me. And sorry for the first G1 that I'm not present physically, but only able to be here through the internet. So yeah, I think echo a lot of Larry's comments. I tend to think about it as fear and greed drive most business decisions. And right now, there's a tremendous amount of fear. And I think the uncertainty that is hard to miss. And I think it's unprecedented, actually, which is a dangerous word to use for a person of my seniority, and by that I mean age. I don't think I've ever seen such an uncertain market. Financial crisis, I don't think was as uncertain. It was more negative, but there was sort of clarity to what we should expect. Particularly because what the U.S. role on the international stage right now is creating. I think people in boards are fundamentally saying, I would rather wait until things are a little more clear. And because people, the fear is making a mistake. And I think right now, because of the sort of inability to have clarity to what the economic growth is going to look like and which sort of sectors are going to survive, that's a big piece. But the second piece, and I think Larry alluded to this, is the transactional risk. So you could have an economic deal where you got comfortable that the growth prospects of the company you were going to acquire made sense, and yet the reality is that deal might not get done. And so I don't think that is dramatically different, but the expectation coming into this year was that was going to have a dramatic shift the other way. We were going to see more comfort that deals were going to be approved. So we wouldn't have a Figma type deal where Adobe, agrees to spend $20 billion and it doesn't happen. So I think that the key message right now is we thought we were going to have an unlock. There was probably some pent up demand. And what's happening is smaller deals are continuing to happen, but the bigger blockbusting deals, and there's exceptions, like a Google Wiz is a great exception to give us some hope that someone could decide it was so strategic in the case of Google to have a bigger security footprint that they're willing to take that risk. Now, we don't know yet whether that deal is going to be approved, but we know that they had a mentality that they would sort of take that risk. So from my view, summing up, Catherine, we have more uncertainty than we've ever had that's going to make buyers in the boardroom very uncomfortable. And then on the seller side, the last thing I'd say is that hope springs eternal. And so when the markets are uncertain, which tends to drive down prices that people would pay, sometimes if the economy for a specific company is so threatening or scary, they would say, you know what, we'll do a deal at almost any price. That's not happening as much as you think it might. And companies are saying, you know what, particularly in tech, I think we'll get through this, and I think our company has the strength to be very successful in the future, so I'm going to wait. So when you have buyers that are not as aggressive as sellers in making something happen, it gets very tricky to get deal flow back up. Again, particularly for the big deals. I'll just leave you one fact. In the last year, both UiPath and DocuSign, two companies I'm on the board of, have done M&A transactions, but they've been in the $100 million, $200 million range. Those deals are still happening. It's the bigger blockbuster deals that tend to make headlines where people don't want to take that risk. And that, I think, is not going to change for the foreseeable future.
Thank you. And Stephen, you really sitting in Japan with a global view. How is this the same or different than what you're seeing based from Japan and from Dai-ichi's perspective?
Sure. So good morning. Thank you, Hori-san and Catherine. It's great being here. We're now active in 10 markets, and we have 5 life insurers in Japan and 1 pet business and 1 welfare benefits business. So we have been incredibly acquisitive during that period of time. We are also one of Japan's largest investors in startups, both here in the United States and in Japan and around the world, in fact. And we have an incredibly long view. So we see changing customer preferences in Japan with aging has been forcing us to look overseas, hence our diversification. And we love this market here. It has everything. It has growth, it has entrepreneurialism, innovation, and it also has a maturity, and we hope still rule of law, and we hope still in certain markets some level of predictability. So we are still extremely optimistic. And it's really with our long-term view when we are looking at potential investment targets, including here. We just closed a deal in Australia last week. We bought 15% of a pension manager, which, actually that number was not announced, but it was a reasonable sum in the order of what Dan just mentioned. So we are still optimistic about those types of deals. We are also fortunate to be in a business which is quite localized: life insurance, investment products, asset management, wealth management type products, where we invest in the United States and we have purchased in the United States. We sell to Americans. We invest in US jobs, and we like to think we expand the economy here through our yen that we are investing. Where we invest in startups here, we also offer them the opportunity to partner with us in our markets, including in Japan. And that is one of, I think, our strengths and what we offer to them. So yes, there's unpredictability right now. I think, as Julian said earlier, it's still very early to see where things are going to land. Tariffs could have grave economic circumstances which would impact our customer base here and around the world. And that would mean that we would have to adjust some of our business strategy. But as we are looking to grow globally and grow in more markets and expand, we think that we have a long-term view. We have a view over 10, 20 years into the future. We're 124 years old. And we're building a business for the next 124 years. And that is going to be a much more global business, part of it predicated on stuff we're going to build ourselves, but also through our M&A activity and overseas investments. So we are cautious, but still very optimistic about the opportunities and the opportunities here for inward investment into the United States.
Amazing. And before we go to areas of strength, Larry, when you think about both with your hat on as a deal advisor buy and sell to all of the corporate teams that you work with, and also as a prolific investor. I mean, you've invested in how many companies?
About 200.
200. So there was pent-up demand for sure. People on the runway looking to 25. And now, as Dan mentioned, particularly in the blockbuster space, there seems to be a stop and wait. So how are you helping those boardrooms and those exec teams think through how to make the most of 25 if it truly is kind of a standstill as far as valuation and value creation through M&A?
I think on one vector, a lot of companies, in particular the private companies that have raised a lot of capital in the 2021 and the ZERP era days, have had the luxury of spending the last couple of years really refining their business models. So I think they have a bit of a head start on thinking through not only where the efficiencies lie in their business, but how AI is going to create even bigger efficiencies in their business. So I think companies have already started to think that way. The other dimension is that I think Jesper touched on this earlier in the plenary session. We're not at that point yet in this cycle where people are confident enough to be greedy, where people are fearful. But I think a lot of people are thinking about how to partner and how to build new ways of distribution, tackle new markets through partnership. And I think you're going to see a lot more, as Stephen said, corporate investment in the minority or majority control type realms, where you really get to work together, combine DNA and try before you buy, essentially. So I think we're going to see a lot more of that, and I think there's a lot of strategic thinking in the boardrooms happening around those realms.
I like the actionability of being able to use this time for strategic corporate strategy and partnership and collaboration particularly for global scale. The vantage I have is looking at Globus Capital's companies that are being founded in Japan and then really actively, aggressively scaling their businesses through the US and other markets. And that strategic partnership opportunity, I do want to impress upon the founders in this room of how quickly can you create additional value by looking at global partners for scale. That is something you can control in this environment. You can absolutely control the collaboration possible with really large companies in your space. So it is actionable there. Dan, when you're talking to your CEOs and your business partners in these exec teams, what is your advice for them as we look at kind of a potential pause and managing the chaos? What takeaways are you seeing that are helpful?
Yeah. So two things I would say. The first one is building on your last point. It's not that the uncertainty is stopping new company formation to occur. There's a robust capital market for early stage companies, and you're a great example at Globus Capital, that are looking for those growth stories. And because of the paradigm shift that we talked about with AI earlier, I know maybe we're saving AI for the end, but you can't. It keeps jumping its way in. I think people are excited to invest in those opportunities, and great entrepreneurs are seeing additional growth opportunities. So I think that's a first piece. Second piece is that I think the lifeblood of M&A in the tech space has traditionally been growth, and I think that aspect is still there. And I think particularly with the paradigm shift of AI, we're going to see an accelerating of growth in companies that are doing well. It also means there'll be losers that will have their growth sapped. And so that creates sort of two phenomena that gives me some hope that, well, maybe not in the next quarter, but in the slightly longer term, we will see the deal flow return. Companies that do incredibly well and have demonstrated that they have a growth story that is enduring, they will find a way to be purchased if that's something they want to do, versus IPOs or staying as independent companies, because the growth will be valued. People want growth. It's why they come to tech as investors. The flip side, if it becomes clear that your asset needs to be, as we sometimes say, milked, it's a point where it's not going to have a great growth story. We have over the last 10 years a dramatic increase in private equity firms that have stepped into tech, where they used to not be able to be as strong in tech because they couldn't justify the tech valuations in valuing everything on an earnings basis versus on a growth basis. But now we have a whole industry of tech sort of M&A occurring from private equity firms that say, we see that there's a stream, not a good growth story, but a stream of earning
Dan, you're
in a sort of milking their profits that they've built versus being valued as a growth company. But for some companies, particularly when you have these new technologies, that's what we can expect.
Great, thank you. I do want to move on to areas of strength, and I'm going to ask Larry to tell us a little bit the tale of two cities as far as AI. But before we go to AI, Stephen, are there segments from your vantage point where you sit in Japan? Are there segments that are really meaningful right now for value creation that you're excited about and that Dai-ichi is actively considering?
So we don't cover tech now, or that's...
Tech is
Oh, okay. Yeah, so I'm head of technology, CIO, and that's what tech is what I do and what I'm interested in. And tech is one of the major growth areas that we are looking at, both for enabling our business and as platform businesses that we would like to be part of. We are coming under shareholder pressure to improve our ROE and move away from balance sheet heavy businesses to balance sheet light businesses. And so we have been investing in platform businesses where we both use those platforms. So, and then we would look to sell those platforms in partnership with the startup and get upside in whatever that business might be. There's an example of this in Sakana AI, one of Japan's first unicorn AI companies, and we are investors in that. And we're working with them actively to reimagine some fundamental processes in insurance and remove friction from the customer experience. And then the tools we will build as a result of that collaboration will become part of potentially a future platform which they would sell. So that type of platform tech business, which is very balance sheet light, is extremely interesting to us. And then there's other financial type businesses in wealth management, asset management, particularly here in the United States. And we recently bought a group business in New Jersey at the end of last year. That's a corporate insurance business that is also balance sheet light. And we see growth, potential growth in this type of group corporate financial services type businesses. So quite a lot to unpack there, but driven, I would say, by tech.
Amazing. I am excited to hear that, as we do have control here, we have agency in being able to drive some value creation forward in the areas that are yet unchanged. And so, Larry, the AI world, I feel like you really do have a front row view on the absolute astronomical growth of AI that's fueling Silicon Valley's technological innovation. And we were leaving 24 really thinking that AI was almost overhyped. It was frothy. There was going to be a correction perhaps in 25. What are you seeing today, and what is the tale of the AI city from your view?
It's interesting because I think earlier I said it's more of a paradigm shift than a platform shift. I think in any new technology, there's always the promise first, and you don't really live up to the promise. But how quickly you catch up to that promise is telling. In AI, it's just been incredibly fast. So the other thing I would sort of say with respect to AI is it's highly multidimensional, because when you think about it as a paradigm shift, you got to unpack all the things that fall out of that, right? So when you deploy AI in a company, you're not really deploying a product. It's changing your workflows. It's changing your organizational structure. In many cases, it's changing or forcing you to rethink your pricing structure. Really, what kind of a company would you be today if you were AI forward or AI native company? All those are big questions. It's not just like sort of put the widget in here, we make finance more efficient, and that's great, right? Sort of like SaaS. The other thing is, I think a lot of companies, legacy companies, even legacy tech companies, are not equipped today to really fully deploy AI. And what do I mean by that? I mean, like there's when sort of machine learning sort of came up the people didn't have data science teams, right? Similarly, now there's not a lot of companies that have AI ops teams that really know how to deploy and integrate these technologies throughout the organization. So there's a lot of things to think about, and therefore the flip side of that coin is there's massive opportunity that is moving very, very quickly. So I think, you know, when you think about it, or when you view this through a venture capitalist lens, of course, like any major shift that happens like this, you have to make a lot of bets. And I do think there's a lot of companies that are going to wash out. But at the same time, you know, there's value, as we always say in Silicon Valley. There's no failure, there's just learning. And that learning is so important right now to capture, especially if you're scaled legacy companies, even the hyperscalers, right? So last year, you know, we invented and did a lot of the what are now called scaled acqui-hires. And I think this was addressed in the plenary session earlier too, is that, you know, this period, this time is a good time to insource a lot of talent. Now, I disagree with the view that there's a lot of talent out there that's available, right? Especially in AI. So that's why you saw a lot of these deals happen where instead of trying to hire onesies or twosies off the street, you would essentially acqui-hire the entire company so that you had critical mass in terms of know-how and learning on how to do this. And so going back to a point we were talking about earlier, you know, this, if you think about it from that perspective, that strategy, it is a great time to partner, to in-source talent, to really get ahead of the curve. Because as I've heard a lot of AI leaders say over the last couple of weeks, like if you are not actively using and experimenting and working with AI today, you're going to quickly find yourself behind the curve. So it's one massive bright spot right now in the markets, and I think AI will continue marching on, to its own drum for the foreseeable future.
Could I just add, just to follow on from, I think a couple of really important points that Larry just made there. And I like the expression scaled legacy. We are just a legacy company, not even scaled. And Larry mentioned about being prepared for AI. Insurers are largely data-driven companies, and we have tons of data about people, our customers. Yet the data is scattered all over the place in no shape or form, no governance, no strategy. And without that data and being able to capture it and know what it is, to then apply any form of AI tool is extremely challenging. And I think we're evolving and we're changing, but I think we are a good example of companies that are trying to accelerate the change to take advantage of AI. And the next point that Larry made, which is, I thought, really important, is in housing the talent. So last year, we hired our first chief AI and data officer. We hired her from the Line Corporation. And so it's a little unusual for an insurer to hire from a tech company. And she is leading the charge in managing our data. And then the other point that Larry mentioned was about partnerships, and the talent isn't out there. And we manage our partnerships where we are investing in startups. And I mentioned Sakana AI as one example. There are several others with a nice balance through our new chief AI officer. So getting the data straight and making sure that's in the right shape and form, having the right level of internal talent, not completely relying on external consultants, and then partnering with the right startups that we have some skin in the game is the approach that we are taking to those couple of points you made.
Yeah, if I were to frame it in my mind, you know, there's these really three important components. There's, as Stephen mentioned, the data is something that I didn't talk about, but that's essential. And then, you know, there's sort of product-focused engineering teams who, as I heard Jonathan Ross, who's the CEO of Grok, say last summer, I would rather have an engineering team that's shipped product time and time again and teach them how to learn AI than have an AI researcher or academic that's worked with frontier models that's never shipped a product before, especially in an enterprise environment. That's really important. But those researchers and academics and everybody who's working with the frontier models are going to become equally important to the other two legs of the stool, because you know, we're in an era right now where some of the dominant AI companies are just exposing their API and you sort of just use it like any other API. So, but you have no idea, what the model weights are, how to like fine tune the models for your own enterprise data set. All of that now is coming to the fore with the rise of open source and really taking these models and working with them on-prem or hybrid on-prem and in the cloud. Like people need to know how to play with the models themselves. And so it's a question of like bringing it back to M&A or partnerships or whatever your strategy is assess whether you have those three elements internally at your company and think about how do I get them, right? Whether it's by partnership, through an acquisition or otherwise.
I'm going to tee up Dan to be thinking about this question, then I have a follow-up question for Larry. But Dan, you as CEO, massive company at DocuSign, and then across the boardrooms where you sit, how are you thinking about talent and succession and ultimately what you have to bring in to bolster valuation for the companies that you're operating the boardrooms? How are you and your board directors thinking about building teams and building valuation in this AI era? I'll let you think about that. But Larry, the question for you also is on the regulatory side. I mean, we did in Silicon Valley really, one of the advantages of this administration was it was potentially going to be deregulation, and it was going to be deregulation in the face of really complicated technology. I was part of the Libra team at Meta where we were really forcing the conversation as technologists and then ultimately in Congress and around the world around cryptocurrency and blockchain and how it could revolutionize financial inclusion in the world and, ultimately strength of payment processing and really bringing down P&Ls of our large companies in the payment processing arena. There were all kinds of advantages that were coming. And we found that the regulators and the policy holders were not educated enough about the complexities of the technology in order to support the value creation we were driving. So are you seeing that in deals today, even in the AI sector, so much opportunity for value creation? Where are you all in also helping your policy teams that you work with educate the government so that they can come along quickly?
Yeah, crypto and blockchain is an interesting analogy to what's happening in AI right now. And I would argue, like outside of every other industry, it was in crypto and blockchain, it was less about deregulation, more about let's move away from just enforcement, which Gensler was sort of, a proponent of. Let's just enforce, our old rules work fine. Whereas Coinbase and others, the leaders in the industry were like really craving actual rules, right? To the point earlier, is markets hate uncertainty. We just want a set of rules that we can understand, work for. Sometimes those rules cut against you, sometimes they cut for you, but like at least the rules of the game, right? And I think that in AI, what's driving that conversation now is the fear, just like in crypto, right? Like you sort of like had uses of crypto for black ops and other bad things that are happening in the world. AI, I think it's just even more attenuated. And so, to your point, Catherine, about people in government not being in a position to really make that law, I think that's always been the case. It's nothing endemic to this administration or the last or whoever. I do think it's on the participants in the AI space to really work hand in glove with government to sort of, first of all, identify the dangers, and then second of all, have an open civil discourse around like, how do we regulate that, right? And, it's not enough to be scared and say like, let's shut all that stuff down. That's going to stifle innovation. But what is the right rule set to govern? I personally think that, it's more transparency and monitoring as opposed to, what we see in the EU AI Act, which is like, well, it's, all usually very generic from the EU around like, if this has bad effects, then you have to like, put guardrails around it. Well, it's really hard to interpret that type of rule because it's so vague, right? So I think it's an important discussion. And then a subset of that is you're having this ongoing debate around, who has the best standing, right, to do that. Is it the closed model developers? Is it the open source community? Is it the researchers and academics? who is that? So, we are, as a firm, trying to align with all of those stakeholders and really feed in, to the government and sort of what this means. I think there's a bigger push-pull here in terms of like what is happening, whether you take a free market approach or is this a nationalistic issue or not? So again, AI, very multidimensional issue. I do believe we do need some regulation so that, the corporate concerns aren't left to sort of decide, how does this AI evolve or where?
Thank you for that picture. I'll go to Dan, and then I also want Stephen's perspective on, in this era of AI being a huge opportunity for us for value creation for all of our businesses, how is it changing how you think about what's necessary on your exec teams and your leadership and your strategic vision for the company? And how hard is it to get up to speed there so that you can deliver on it quickly? Dan, first of all, I'll go to you.
Sure. Well, on the talent side, I think in most boardrooms, there's sort of three core levels that people are thinking about. First is I'd call this sort of strategic perspective. And I think boards are expecting their executive team to have a point of view on how AI should be sort of imbued in their business. And my perspective, there's sort of two core components of that. One is, should we be building or changing the products that we're building? And in the tech space, that fundamentally is around software products, but over time we will see hardware as well. So what's our involvement? And should we be changing the way we serve our customers with AI? And then the second one, is referred to earlier, is the idea that, well, how much should we be running our business better? And so executives need to understand where there are opportunities to run their business better. So that's the first piece at this sort of strategic level, is how aggressively we need to do it. And the answer is very aggressively is probably the right answer for most companies, if not all. And then the second piece is, if you think about the way SaaS software came into place, you go back, 15 years ago, we didn't really realize this, but eventually the vast majority of our employees are interacting with SaaS software. So it's not going to become a situation where it's this dear and rare skill. Everyone uses SaaS software today, employees at your companies. And so I think the next big challenge is figuring out, how do you get all of your employees familiar and starting to use AI? And I think you see a lot of companies saying, we just need to get people having a Claude or a ChatGPT or some sort of license so that our employees are experimenting and getting comfortable with it. Like, huge move that companies need to do to ensure that their workforce has what will now become a clear, important, modern tool set in the way they do their work. And then lastly, and this isn't appropriate for all companies, but some companies, when they do that strategic assessment, will decide we need to do more about building AI tools. So if you're a software company, again, it'll be the vast majority of software companies are going to say, yes, we need to go out and bring in the talent that really is capable at building this next generation of software. That's going to be the hardest part, because as Larry indicated, there's not a whole lot of this talent to go around, and there's a tremendous amount of demand. So from an M&A standpoint, the place that's really relevant, I think, in this conversation is those kind of acqui-hires where companies say, I just need a lot more of this DNA in my company. And strategically, the smart thing is to pay a pretty big premium, because that's what you're going to have to do to bring in a critical mass of AI talent.
It's a great segue into cross-border that I want to talk about next. But Stephen, how are you thinking about, as running all of digital, this topic of how quickly can we bring Dai-ichi up into innovation era and AI, and then through your teams, through your employees? How are you? What percentage of time are you spending on this, and what's been the outcome?
Sure. So I have been around and in tech long enough to remember the days where there was technology called data processing was a separate department, and they did all the so-called tech, and that was it. And things got thrown over the wall to us, and we would deliver something, and life went on. And that changed somewhere along the way. I don't know what element of tech did it, but it certainly applies to AI and the need to democratize this technology, because the power of AI is the ability for all of our staff to be able to use it to reimagine their jobs. Now, we are tackling this in a couple of different ways. One of the challenges we face is we have a big long line of consultants knocking at our doors and at my fellow executive doors to come and sell products. And my fellow executives have unfortunately been buying those in ignorance. and starting to adopt those AI solutions and train those AI models on our IP and our data, thinking that this is just the same as any other type of technology. So we are trying to rein that back in and bring some level of governance while also training our executives. I mentioned that we brought in from the outside a chief AI and data officer, but the area that we're spending a lot of time on is education. And there is an academic at Stanford called Eric Bridge-Nolson who has coined a phrase called the productivity paradox. And the productivity paradox, in short, is basically he thinks that when a new technology, he was asking the question, when a new technology is launched, why is there a productivity paradox? Within a few years of that new technology, we do not see large increases in productivity. He had several reasons for this. And one, he said, was the problem with the curse of knowledge, he called it. And that was knowing what your existing biases. We've been around 124 years, pretty much operating in the same way. And one of our biggest challenges is the curse of our knowledge and unlearning how life insurance works to then apply these new tools. We don't just apply it to existing processes. We have to eliminate that and reimagine our business. So we are spending a tremendous amount of time, not just educating our staff on how to use Copilot or whatever it is, but how to reimagine their business to use these new tools so that we don't suffer the paradox of productivity.
Mm-hmm. And I'm hoping that as somebody who's chief business officer of a company, that we are actively bringing in AI into our software for our own valuation creation, our appeal to the market. I'm really hoping that there's massive success here as far as being able to adopt it quickly across employee bases and deliver SHIP accordingly. Larry, did you have anything else to say before we go to cross-border?
I just wanted, this is sort of the bridge to cross-border, I think. I think that cross-border M&A is the sort of antidote to deglobalization and nationalism. If you think about it, learning to integrate companies and other cultures, if you believe a diversity of views drives better innovation, right? Then I think this is the time to actually really think hard about cross-border M&A and whether it fits with your overall company strategy and the markets you're targeting, et cetera. Obviously, you have to do that first, but it's a great opportunity. Historically, the statistics have been 60% or thereabouts, let's call it 2/3 of M&A fails. Why? Because it fails because of failure to integrate organizationally, and there's a cultural difference, right? And that's true for domestic M&A in technology as well as any other industry. And so I think thinking about whether you can acquire teams that have done things differently elsewhere and bring that DNA into your company is a really important strategic imperative right now. I'll just take the example of Europe, right? European companies were always sort of at a disadvantage to US companies. If you take Europe together, it's about the same aggregate population, 300 million, give or take, but there's 25, 30 countries within that. And in talking to a number of European CEOs, they sort of said, well, we have to grapple with all these cultural issues. We didn't grow up with one, set of humor and one, culture that we were all consuming. So learning how to work together. But, in the end, I think European tech companies in particular learned how to behave as one market with a whole bunch of different cultures, and they're stronger and better for it. And we're sort of seeing that now. So, I'm a big proponent of that, especially in this environment.
While we're asking people to think of your questions for our esteemed panelists, Dan and Stephen, just quickly on the topic of the dynamics, Silicon Valley has been at the forefront of acqui-hires and kind of leading. How do you bring in talent from all over the world and quickly bring them into your organization? Integration challenges aside that Larry teed up. And yet the US may have a very difficult time keeping foreign talent in the country, and there may be real restrictions into how people can stay in the US in this current administration for the foreseeable future. So is that informing the way that you also think about talent acquisition, technological acquisition, the ways that you're thinking about M&A strategy worldwide?
I'll start. So cross-border, I would say, is going to be dramatically hurt from an M&A standpoint in the foreseeable future. And it's for two reasons. One, the nature of your question was, hey, isn't this an opportunity, as Larry indicated, for companies to get more diverse talent and make their company stronger? But I think the answer is people feel right now it's going to be very difficult to act as a global employer from that standpoint and move people around to different environments because of immigration restrictions. So even company sponsored, as we're seeing in the US, is going to probably be dramatically limited. So while I'm hopeful that on the tech side, things like the H-1B visa program will continue to come back from some of the nervousness we've had in the last few months, I do think that people are going to be less clear. Again, the uncertainty is what will I be able to do in the future? And if I don't think I'm going to be able to do that and run my global enterprise to take advantage of all those diverse perspectives, that will pull back how I think about how aggressive I want to be on cross-border M&A. And then the second piece, and I think this is sort of tricky right now, but as we think about the phenomenon of a global company where we have things like global supply chains and a sense of certainty that we can control the movement of those goods and other technologies as well, that's been challenged in a way that I don't think has been really addressed, since David Ricardo figured out comparative advantage 200 years ago. I don't think we've had this much challenge on how we're going to think about global trade. So while I am hopeful that that will work its way out in not too long of a period of time, the threat of US-driven, I'll call, in my opinion, bad trade policy or overly aggressive use of tariffs to reduce the ability for the free flow of economically rational free flow of goods and services, I think is actually going to make that kind of cross-border M&A much harder as well.
I'm really hoping that Japan has a really viable startup culture, and there are some incredible companies being built in Japan. The startup community is more innovative and exciting than ever, and I'm really hoping that as somebody who's made a career in Silicon Valley, we start to see other pockets of stable governments and really advanced technologists take advantage of this time to start building up their companies through cross-border M&A because they're sitting outside the U.S. Anybody in the room have a question? Any questions at all? Yes, this woman here in the green. And please just give your name and where you're from too.
My name is Tasha Yorozu. I'm an attorney at Miura and Partners US, which is the US law firm of Miura Horitsu Jimusho in Japan. I am the managing attorney there. This is very intriguing. We've been helping Japanese companies do M&A in the United States. In that, their approach has always been, take your time. If it's the right match, it's the right match. Like you said earlier, try before you buy. That was their standard. Now, because of this environment, that seems to be the trend, but that seems to be Japanese companies' strength in a way. It's something that does not change. Are you observing that as a trend, or do you think this is just a fleeting thing because it's so disruptive right now?
Great. Blair, do you want to start with that?
So just so I understand your question, the trend of sort of trying before buying. I think it's very much what is the corporate culture in the country that is coming in. We were talking about this earlier. I think the Nippon Steel, US Steel proposed acquisition is going to be highly symbolic for a lot of Japanese companies, right? As you probably know, the CEO of Nippon Steel went on Japanese television, and it was more of a US CEO style, let's fight for our rights. We're going to sue the government. You saw this sort of cultural shift in France before, in a jurisdiction where people really didn't believe that entrepreneurialism, even though that's where the word came from, was something to be embraced. And now you see the changes. I think Japan has a massive opportunity to embrace that sort of boldness. Now, obviously, as we talked about earlier, there's like this, uncertainty that surrounds us right now. And I do think the safest thing is like, let's continue with that mindset for the time being. But, ultimately, that's why I believe that, cross-border M&A is one antidote to deglobalization. I think, people should be bold. The speed at which things are moving, especially in technology, especially in AI, behooves sort of thinking more of having a larger component of M&A in their diet to move the needle as opposed to organic or incremental growth. So hopefully that gives you a perspective.
I can just add a couple of practical examples. So I would say the try before you buy is very much in our DNA. The example I quoted of the pension company in Australia, we bought 15% of that. We just purchased at the end of last year 15% of Canyon Partners, which is a hedge fund in LA. And we 2 years ago, we invested 10% in a welfare benefits company, in a startup company in the UK called ULife. And it is partner with the companies, bring them to our market, learn about their ways of working. If we get on well together, then we'll go deep, and usually we have options to take the rest of the company, and that sometimes happens, or in some cases it doesn't happen, and we get out. So I would say it is a very much a fundamental part of how we think about cross-border M&A.
Brian, where do we go next? Thank you.
Hi, my name is Tatsuo Kawasaki. I run a private equity fund based in Japan. At a high level, my question is this a good time to be buying or selling? Without the tariffs, generally speaking, the economy was slowing down, right? It was basically debt-laden growth during and post-COVID. The US, Europe, and then China is slowing down regardless. Europe is a mess because of the war and stuff. So confusion because of the current admission is definitely adding to it. But taking a step back, is this a good time to be engaging in buying or selling businesses?
Dan, do you have a perspective just from the boardrooms that you sit in? Is this a good time to be buying at all?
Yeah, I think, first let's start with the data, Tats. Like there's the phenomenon of very few transactions are occurring, so very few people are buying. And I think the reality is it's a very difficult time to sell right now. So I guess if I had to ask the question, is it better to be buying or selling right now? There's a paucity of people who are buying, so it's tough to sell. And I would say it's a bad time to sell. I don't know that I think it's a fantastic time to buy because of the uncertainty that you raised, but I definitely think it's a better time and a better market with so much capital that we have that's available to be buying than it is to be selling. And I think the private equity firms are the ones that have the strongest point of view because they do so many transactions. And as you can see, many of them are struggling to make disbursements to their limited partners right now because they are really struggling to find good exits. So yeah, I'd come down pretty strongly. It's a better time to be buying than selling right now.
Larry, does that hold with what you're seeing?
So I would I'd put a different lens on it. Like if you're not in the game, you're not going to be able to play. So what I mean by that is you should be actively looking right now, right? And I think there's two sides of the sword, right? As the economy slows, obviously multiples will compress if you're actually buying the business for acquiring the business. If you're buying the business for technology or people, right, in a market that is fairly dry, you might find a lot of resonance, right, with that team if they're going to a better home or a more stable home. So I think we're still seeing a lot of activity. I agree with Dan that we're not people pulling the trigger on deals to slow down, but you also don't want to be caught out where everyone's greedy and then you're trying to run through the same door as them.
Thank you. We have time for maybe 2 more questions. Here.
We can take 2 at a time. We can take several questions at a time.
Oh, okay, great.
Before they answer.
Okay, excellent. So Kojin, if you give us your question, please, and then we'll have another person ask their question.
Cool. Hi, thanks for the panel. I'm Kojin. I'm a founder of an AI security startup called Robust Intelligence based in the Bay Area. We're actually a proud client of Goodwin when we sold the company to Cisco. My question is, I think in the past we've seen traditional companies buying tech companies buying tech companies. One thing that I've been recently noticing is tech companies buying traditional companies, specifically SMBs, to do AI roll-ups. So these are relatively new companies raising a ton of capital and leveraging that money to buy distribution. And my question is, one, are you also seeing that? And two, if so, where do you think the trend is going to go?
Okay, so Kojin's question, do we have one more question? You wanted to roll these up, Brian? Yes, sir.
That's great.
Victor Wan, managing partner of MTalk Ventures. My question is regarding how do you assign values to the acqui-hire? It used to be $1 million per head. Nowadays, for AI company, you can have 3 people create tremendous value. How do you sell or acquire these kind of companies?
Okay, great. We'll start with these two. So Larry, if you could address Kojin's question, and then I'd ask the operators, Stephen and Dan, to address, what is your name? Victor's question.
Kojin, you're spot on. You know, we've seen that trend sort of emerge 18 months ago, and it's only getting stronger. You know, the sort of bedrock is, hey, AI can actually create massive efficiencies and growth in companies that have big installed bases or distribution that are essentially never have leveraged technology or have, frankly, in technology companies like we did the Zuora take private, right? Like that was a company that got their growth declined to about 10%, but they had a massive install base. So like, can you take that and AI-ify it now? And frankly, like that's in the playbook of both sponsors and strategics, I think, these days, and that's going to just continue.
Great. And then what I heard from Victor was just value of talent. So acqui-hire, and sometimes we look at technology talent coming in. So it's either a technology purchase or it's a talent purchase or both. Are there changes, Stephen and Dan, how we're thinking about the value of those talent purchases?
Yeah, it's a great question, because we will acquire companies, especially technology companies, for the talent, or if they have some core technology that we think might be useful. The core technology is slightly easier to value, but the talent, it's years of experience speaking to those founders. Can they come and work with us? Can they integrate into a 124-year-old organization? How does that feel? And then if we were to have that talent, what value, what tech can they deliver for us? How can we apply that to our customers? And then what kind of revenues does that translate into, and at what speed? We're not great with speed, so we value speed very much. And if we think there is a technology company we could acquire that could give us that speed, we would be willing to pay more of a premium for it. I don't have a mathematical formula, unfortunately. It is years of experience of dealing and working with technologists and looking at the problem statements we're trying to solve and seeing if they can help us accelerate that.
Dan, you know, Victor referenced kind of that old formula of $1 million for an engineer in tech, and I'm going to ask Larry about the AI engineers in a second, but are you seeing anything, Dan, in the boardroom that's shifting there?
Yeah, I think it's a great question because of that. And I think what happened is we used to have sort of this discomfort with companies saying, why would I spend so much money in an acqui-hire? Why don't I just go hire the people and give them, why am I giving the investors sort of a bailout in a company that has not been successful, which is usually when acqui-hires happen. And then we came to this concept of, $1 million a head for engineers, and everyone got comfortable that meant I was making a responsible decision if I didn't pay more than $1 million or much more than $1 million per head. Today, if you take a look at the AI acqui-hires, they're dramatic multiples of $1 million per head. And I think the reality right now is there is not a comfortable zone. So I think if you're looking at making one of these bets, it actually becomes these scary bets where you're actually trying to figure out not what they're worth in the marketplace, but they're worth to you. And so I think what companies are now doing is saying, well, here's the size of my business, here's the potential impact, and it may be, you know, sort of solvency. I may decide that without these investments, I can't continue to value my business the way I have traditionally. So I think that right now it's mayhem. You know, I think it's a little bit of a goat rodeo in trying to figure out these valuations from an acqui-hire standpoint. But the reality is the market is trying to get settled on each transaction, because usually there's multiple companies now that are looking when an AI company decides they don't have a bright future on their own and they want to try to monetize their talent. It really is a phenomenon that's crazy. And the data point that I'd give you that's even the crazier part is if you look at the alternative, which that talent could go start a new company. If you take a look at some of the valuations, and this is particularly for all-star AI talent, people that have, worked at OpenAI or coming out of some of these sort of factories that have been so successful, they are getting billion-dollar valuations before they really have a substantive business. And that has just never really happened at this same level. So I think it's going to get crazy and stay crazy on how we think about these valuations. And it's going to be a long time before we settle on something like $1 million per head of engineer.
Larry, 30 seconds as we wrap up.
Yeah.
How eye-popping has it been?
It's a great question. So I won't name the bank, but a very reputable bank is now the benchmark is 5 to 15 million per head for AI. Now, I would advise you never put that in a board slide because it's just sort of ridiculous. I think Stephen's point is the right one. You have to be disciplined to look at it through the lens of what does it mean for your business and value it accordingly. And if you're going to compete against others, it's to someone else, it might be multiples of that, right? So there's really people like to bandy about these statistics, but I would never reference them. It's sort of what does it mean to your org?
Thank you so much. Dan, thank you for being here so early in your morning in Tokyo. So lovely to see you. Stephen, Larry, thank you very much for your insights and thank you for your great questions.